Hello, everyone. My name is Jeff Brown. I am a business broker with Business Acquisitions. I'm also a former M&A attorney and a former entrepreneur. Today's discussion is going to be about some ways that you can increase the value of your business and also make it more attractive to potential buyers. We're going to be focusing on smaller businesses today. So really that's kind of any business with revenues up to, say, $1 million. Once you get above that and you get, 1.5, 2 million and above, you start dealing a little bit more with private equity firms, and that's a little bit different discussion. So we're really talking about owner-operated businesses today. And this is going to be a shorter discussion of a paper that I produced on the same subject. If you'd like to get that paper, just shoot me an email to jbrown@baltd.com, and I'm happy to send that to you. First off, when trying to make your business more valuable for a potential seller, the more planning you can do, the better off you're going to be. The earlier you can get started, the better off that you're going to be in the long run. For valuing a specific business, I would need specific information on that business. However, a lot of the factors that buyers use in buying small businesses are the same across virtually every industry. So no matter what type of small business you've got, there's a good chance that most of what I'm talking about is going to apply to your business. The first thing that you need to do in order to increase the value of your business and make it more sellable is deal with your financial statements. Clean those up. I have dealt with tons of sellers in the past. I've also sold 5 of my own businesses, and there's nothing more important than the numbers. If you can't get if you can't get a buyer interested and excited about the numbers and explain them in a way that a buyer is going to understand, then the rest of the stuff I'm going to talk about is not going to matter a whole lot. The problem with trying to establish the value for a buyer and having them look at your financial statements is they're going to want to see your tax returns. And most businesses keep financial statements so that they can do their tax returns each year. And they want to legally, of course, pay as little in taxes as they possibly can. So they're going to ultimately want to drive that profit number down. They're going to want to accelerate expenses. They're going to want to defer revenue. They're going to run personal expenses through the business. And they're going to, in some cases, and worst of all, is they're going to not report all revenues. And each of those things that present a problem in their own way, some more than others. So when a buyer wants to look at your tax returns, ultimately, a lot of this stuff I just talked about is not a problem because of something called add backs. And a buyer is going to expect to see that. And more importantly, so is the bank that's financing the deal. So let's say I've got an accounting business, and I made $100,000 in that business last year. That was my reported income on my tax return. So we're going to take that $100,000 and we're going to look at that. And we're going to say, okay, well, yeah, the business made $100,000, but Jeff also paid himself $60,000, and he also paid for his personal health insurance through the business, and he also paid for his car note through the business, and he also paid for his daughter's tuition through the business, and any of these types of things. So really, we're looking for anything that I, as the owner, paid in the business last year that the new owner is not going to be responsible for. We're ultimately looking for the total benefit that I, as the owner, received from the business. So a lot of those things can be added back. And while that solves the problem in some cases, keep in mind that a buyer may agree that, okay, well, that $100,000, after you add all those things back, it comes to, let's say, $250,000. A buyer might agree that's reasonable, but your real problem is going to be dealing with the bank. Most deals are financed in one way or another, and the bankers are going to have to get on board with those add backs. And one of them I can promise you they're not going to be on board with is not reporting revenue. You're not going to be able to say, oh, well, the tax return shows I made $100,000, but gosh, there was over $50,000 we didn't report. So we really have to add that back and count that in. It's just not going to happen. So the best advice I can give you, if you don't take anything else away from this, is as you get close to the time for thinking about selling your business, and when I say close to the time, I mean at least one full tax year away, you really want to make sure you report all possible revenue, and that you remove as much as you can that really has nothing to do with the business. Like, for example, the daughter's tuition I was mentioning, the other stuff, the health insurance, the salary, people are used to seeing that. And that's not a problem. But the real issue is hiding money. And for every dollar you hide from the IRS to save 30 cents or so on taxes, you're going to cost yourself about $3 in the price of a sale. So, I mean, it's a 10-to-1 penalty. So just be careful and make sure that, again, you want the numbers to show as best they possibly can, because a buyer that's looking at a business wants something that is on the upswing. They want to see something where, okay, well, in 2020 we made $100,000. In 2021 we made $150,000, and in 2022 we're on pace to do $200,000. They want something that's on the rise. And the good news is, even if your business has been relatively flat, I mean, just by sort of restructuring how you do your financial statements and the income and expenses and how you handle those, you can show a business that is on the upswing. So one final thing before we move on to the next thing about your financial statements is wipe out whatever contingent liabilities you can. I have seen so many deals fall apart because of this. And what I mean by that, a potential liability can be a lot of things, but most often it's some sort of dispute that is either a current lawsuit or could develop into a lawsuit. So that could be from employees, from competitors, from customers, from anybody. So let's say, for example, you've got a former employee that is suing you for, I don't know, $1 million, and it's a fairly frivolous lawsuit. Maybe it's got some nuisance value, but that's about it. So you're going to want to try to settle that before you list your business, or shortly after you list it, because anybody that is looking at that business, nobody wants to buy a lawsuit. Anybody looking at that business is going to say, well, it's frivolous. I don't know that it's frivolous. I wasn't here. I don't know the fact scenario. I don't know. I'm not a lawyer. I don't know those things. So you're going to want to try to settle that as early as you can, and just get that off the books, because they're not going to be able to take a look at your business and say, well, how do I price in the possibility that I might have to pay up to $1 million? And that something like that can really, really kill a deal.